Today I have for us the latest annual report of Ford Motor Company. This business's supply chain was really thoroughly damaged by the semiconductor and chip shortages of the global pandemic. And really, since I was a little boy pretty much, it's been relatively well known that America offshores most of its manufacturing. Well, the global pandemic really highlighting this as a potential issue, perhaps for the first time for a lot of these executives. But we could very much consider this an oligopoly that is navigating the cutting edge of globalization. And so I'm very excited to take a look at this for the very first time with you as a researcher at Sage Seeds Capital. I am recording myself live to hopefully give as many people as possible a glimpse at what it looks like to do professional value investment and fundamental analysis. Let's dive in so that your wisdom can blossom. Statement of cash flows. Leaving a year of negative income to now one of positive. One of the largest changes here is actually this row, pension and other post-retirement employee benefits. I mention it because it's very significant when compared to other rows. In fact, it stays an order of magnitude higher than this row, stock compensation. But really, despite what the income statement shows, this company is generating billions and billions of dollars every single year. Revenue actually broken down into a whole section called Ford Credit, maybe actually related to those very large pension amounts. We might need to look more into it. But overall, revenue absolutely chugging forward, very good to see. The balance sheet. Now, if you had told me before looking at this that the majority of the change in current assets would be in a row called Ford Credit Finance Receivables, I really wouldn't have expected a car manufacturer to have most of its change in finance receivables. Even more so when we go to the liability side, again, definitely more than half of the change is in this row Ford Credit. And interestingly enough, they actually at this point categorize it under a section called long-term debt and suggest we look at the note 19. And so in conclusion of the opening move, we're looking at a big, relatively stable business. It's not pristine or anything, but it's definitely not unstable. But whatever this Ford Credit situation is, I think we're going to take their advice and go straight to the note 19 to find out more. I have scrolled for us until we reach note 19. It is titled Debt and Commitments. Oh, this last sentence is what draws my eye. Ford Credit sponsors securitization programs that provide short-term and long-term asset-backed financing. And so that is what we're talking about. Now I'm curious to know how these institutional investor clients felt as a chip shortage made cars scarcity come out of nowhere. Did that affect the value of the asset-backed securities that Ford had sold? Note 19 is, well, very long note here. But as we keep chugging, I want to zoom in on these two rows of the long-term debt payable after 1 year. This is 2022, this is 2023. And in both years, there was more unsecured debt than asset-backed debt. Ford has generated a lot of cash in addition to what it is making on the income statement. A lot of the money it generates comes from the issuance of these types of debt, and that Ford is purposefully always keeping unsecured debt a little bit higher than asset-backed debt in the latest years. A very hefty section within the note 19 now, and I don't think you think the other sections were hefty, this one's even heftier somehow. It's called convertible debt, explaining that not a huge amount, but a meaningful amount of debt, $2.3 billion, was issued in March 2021, blah, 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 blah. This could be converted into approximately 65.5 shares at a price of $15.25 per share per 1,000 principal amount. If you do break that up, that means something like $3 to $4 billion worth of stock could be generated from just this one loan issuance. I know Ford is a big company, but they essentially promised $3-4 billion worth of stock in order to issue $2.3 billion. And they did this in March 2021, which if we look back, was probably a very scary time for most companies, but certainly Ford with the chip shortages coming and all this other stuff. Not necessarily a huge oops. I mean, I don't know enough to call it an oops right away. Lower down in the same section, they explain, we may not redeem the note until March 20th, 2024, which just passed. The fact that they're mentioning this where they're mentioning it really makes me think that they're a bit excited to redeem these before they get issued into shares, if possible. Maybe the reason they actually accepted that back in 2021 is because all along they had the plan to redeem the shares if they were able to and survive the whole chip shortage, which they have. They claim that as of December 31st of 2023, so just a couple weeks ago, the whatever billion that they received a couple years ago is still roughly the face value of the debt. So if they were to completely retire that debt, which I don't know if they're going to do, it will have roughly worked out, but really risking the equity while doing it, if I'm being honest. And finally, probably about to be an even bigger section, the biggest section of them all, we've finally arrived to asset-backed debt, 58 billion, much larger than anything else we've been looking at so far. And the additional information they're giving us here is that it's actually about their leasing business. Ford Credit then, more about Ford not wanting to manage leases themselves. Instead of them providing a service to institutional investors, and there is some element of that, it's actually, the way they're describing it here, Ford sees it as institutional investors helping Ford manage leases so that it doesn't have to do that in-house. But a very good trade where both parties are genuinely getting value from this relationship. Kind of cool to see. And while this relationship already looks so happy and healthy on the surface, we're now going to crank this up to professional status and really dig even deeper. The moment I feel that good, like there's a win-win, well, I know better. I know human nature. There is a secret layer underneath this, is what I'm suspecting, that actually pushes the economic balance towards Ford winning out. And so once again, Ford is extracting the most value from this relationship, I am almost certain, because I suspect this relationship and outsourcing of leases is in order to keep money away from the pension plans. I personally am going to try to avoid saying whether this is good or bad. I mean, frankly, whether it's good or bad, in my view, depends on your relationship with Ford. Some stakeholders won't like this, others will. But the pensions of Ford seem to be somewhat diminished by the fact that as the leasing business of Ford grows and grows, pension remeasurement, the way I'm seeing it defined in sort of the details here, doesn't necessarily capture all the value created from every single lease. In fact, the leases that are sold as soon as possible to a financial institution and then never redeemed by Ford, there's a very real chance that those actually don't contribute to the pension plans in the weird long setup with many rules that Ford has negotiated over decades with its employees. So the win-win I described earlier is still intact, but with the additional fact that these financial institutions are essentially allowing Ford to divert cash away from being put into the pensions. Now again, I'm no expert, I don't know any of the details really about the negotiations that Ford has had that set up these pensions. In general though, Ford would not be the only company that has experienced economic change since these pensions were negotiated, and it is very much a possibility that back when these pensions were first negotiated, leasing of cars was not really even something that they were considering. More and more people choosing to lease a car rather than directly own it, and Ford's essentially working with banks in order to legally remove a lot of this leasing business from the umbrella of coverage that these previous negotiations set up. If this is true, then people will ultimately notice this more and more and really dislike it more and more if the leasing business continues to kind of excel as it very much has at Ford and many other US car companies. But I don't know if we'll ever know the really juicy details, like was this first suggested by someone within Ford, or was it someone on Wall Street that came to Ford with this idea and then they accepted? Not the biggest deal, but just really fascinating to me, like who even comes up with this sort of thing. But okay, these are once again the last 3 years of earnings per share for the company. And I need to give this a ranking. In a second, our Sage Seeds AI proprietary machine learning algorithm trained to identify value investment opportunities is going to rank this relative to the universe of all inputs and give us a percentile rank, where the closer to the first percentile we are, the higher likelihood there is that this is a successful value investment, but the lower down we are, the higher chance there is that this is actually a shorting opportunity or that there's something quite amiss. I don't think there's trouble in the future, even with something like a labor dispute, which admittedly is kind of hard to quantify in any scenario. I'm going to guess this is between the 30th and 40th percentile. But what do you think? Do try to guess, as I'm about to reveal the real ranking. But also share this with your friends. Try to have a conversation about it in the comments. What are you thinking before seeing Sage Seeds AI output? What made you think that way? What small details might you recognize because of your background that maybe not every investor would notice? Ford Motor Company ranked in the 24th percentile in value for the 2023 season. This is kind of significantly higher than what I was expecting. This company is big, makes billions of dollars, and it's pretty stable, dancing around the negotiated pension obligations. And whether you agree or disagree with that, or know the details even, the main takeaway as value investors is that the earnings per share was negative last year for reasons unrelated to the core business franchise. The shenanigans might continue. Labor disputes might start at some point because of this sort of stuff or other things, but the core business franchise packed inside this, just chugging forward. Do you agree or disagree with this? Voice your opinions and analysis in the comments below. Don't forget to like and subscribe for more future videos. And thank you for watching until the end. I'll see you in the next video.